In this video, we're going to look at FLIR systems, and FLIR makes thermal cameras. So thermal cameras originally developed for military use during the Korean War. Firefighters used them to see through smoke. Law enforcement uses the technology to manage surveillance activities. Also, power line maintenance technicians use it to locate overheating joints. So what I do in my videos is I run my discounted cash flow model to figure out the actual stock price for a company. And then I look at the financial ratios of that company, and I do this all on the video with you, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $5.3 billion. And let's find out what they're trading at. They're trading at 40.29, so one share of stock cost about $40. And let's get their free cash flows. And the way we value a company is we estimate the future free cash flows, and then we discount that number back to today's value. And that's what I'm doing here in a video. We also need the net income, and that's on the income statement. That's the profit and loss for the business. And then we're going to pull the revenue, which are just the sales. You want to just look at the numbers to make sure they're positive and consistent, because if they're not, it would be hard to value the company. It looks pretty good, so we should get a good value. Let's look at a capital structure of the business to figure out what discount rate we need to apply to the future cash flows. So the interest expense is $27.7 million. That's how much interest they pay in their debt. And we'll go to the balance sheet to find out how much debt they have. Current debt of $28 million, that's debt due within 12 months. Long-term debt of $648 million, that's debt due after 12 months. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement. $241 million of income before tax. They paid $70 million in taxes, so their effective tax rate is 29%. The cost of debt is 3%. To get the cost of equity, we need the beta. The beta is how much the stock moves relative to the market. So it's how volatile the stock is. They have a beta of 1.57, so the stock moves about 1.5 times the market. Let's get their current assets. We need this because when we look at the current ratio later, this is part of the formula. And current assets are mainly cash, accounts receivables, and inventory. And let's get current liabilities. And this is how much money the company owes within the next 12 months. $413 million. And the equity is assets minus liabilities, and that's $1.8 billion. We also need their EBIT, earnings before interest and taxes. And that's called operating income on the income statement. We need the EBIT for when we look at the interest coverage ratio later. Let's look at a capital structure. So the cost of debt is 2.9%, and they have 27% of debt in their capital structure. The cost of equity is 14.4%, and they have 73% of equity in their capital structure. So the weighted average cost of capital of 11.3% is a combination of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value for the company of $3.9 billion. We divide that by 132 million shares. And we get an intrinsic stock price of $30. It's trading at $40, so it's trading at a 33% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're saying the stock is $42, so they're saying it's worth more than it's trading at. Let's see where the stock has been trading. So it looks like it was trading a lot higher. Looks like it was trading even in the mid to high 60s at one point 2 years ago. Before coronavirus, it was trading about 55. It came back down pretty low to around 20. So it could be a good value. This seems like a good technology with a good future. Let's look at their financial ratios. A pretty high PE, that's not so good, 30. That's price of stock over earnings per share. Pretty good price to sales ratio of 2.8. That's price of stock over sales per share Also a good price to book ratio of 2.8. That's price to stock over book value per share. They have plenty of current assets to cover their current liabilities. They have a pretty low ROE, that's income over equity, so they're not providing the best value to their equity holders. Interest coverage ratio of 10.2, so they can easily cover their interest payments. So FLIR's main focus is on the thermal technology, but they do have competitors that work on this technology as well as other products. The companies that compete with FLIR are MDA, Lockheed Martin, Thales, Elbit Systems, General Dynamics, AeroVironment, Ideal Industries, BAE Systems, and OSI Systems. Some of these companies are really big, like Lockheed Martin and General Dynamics. So if FLIR continues to just focus on this one technology and master it, they may have a competitive advantage over the others, but that remains to be seen. So let me know what you think of the video. Thanks for watching.